Welcome, MHP Rhino Nation, to another episode. Let's get dive deep into MHP's baby.
Yeah. Okay, let's dive right in. We're going to pull back the curtain on a really fascinating and sometimes pretty risky financial tool, the balloon loan. It's a name you might have heard, but trust me, how it actually works, that's the part that really matters.
All right, so imagine this. You're out there looking for a loan, maybe for a house, maybe for a business, and you stumble upon one where the monthly payments seem, well, almost too good to be true. You just know there's got to be a catch, right? So what is it?
And that's exactly the hook. That affordability is what makes them so attractive, especially if you're, not familiar with how they're structured. Those low monthly numbers, they can be incredibly seductive. Let's put some real numbers on this to see what we're talking about. For a $200,000 loan, you could be looking at a monthly payment of just over $1,000. That feels totally doable, doesn't it? It feels normal. But, and this is a big but, this is where the story starts to get interesting.
Okay, so how on earth is a payment that low even possible? Let's get into the secret mechanics behind it all, because this is the crucial twist that explains everything.
And here it is. This is the core concept, the trick, if you will. The whole thing is built on a timeline mismatch. Your payments are calculated as if you have 30 years to pay the loan back. But, and here's the kicker, the loan itself is actually only for, say, 5 years. So you're making these small 30-year style payments, but the clock actually runs out in just 5. And that mismatch, well, that leads to a pretty dramatic ending. We're talking about the final reckoning. This is the moment of truth where the real cost of those tiny monthly payments comes due all at once.
I love this metaphor. It's perfect. That low payment you've been so happy about? Yeah, that's just the tip of the iceberg. What you can't see, lurking right below the surface, is this enormous debt that really hasn't gone anywhere.
And that lurking monster has a name, the balloon payment. And it's called that for a reason. It's this one giant, inflated payment at the very end that covers pretty much all the money you still owe. And believe me, you still owe a lot.
So let's go back to our numbers. For 5 straight years, you've been shelling out that $1,000 a month. No sweat, right? You're thinking, hey, I'm doing great. I'm paying down my loan. And then, bam. At the end of year 5, this number pops up. Almost $180,000 due right now in one single payment. That's the balloon. I mean, think about that. After making 60 payments, you still owe almost 90% of what you borrowed in the first place. Okay, that number is a shocker for sure. But it's not some kind of voodoo math. It's actually pretty straightforward, and you don't have to be caught off guard. So let's switch gears a bit. Let's break down the numbers so you can see exactly how we got there. It really all comes down to a simple 3-step process that just repeats over and over again every month. First, the bank calculates how much of your payment is just going to interest. Then, whatever's left over, that little bit, goes to the actual loan amount, the principal. And last, you just subtract that tiny amount to get your new balance. And this right here, this shows you the problem perfectly. Take that very first payment. Out of your $1,000 payment, $750 of it, the vast majority, is just pure interest. It just vanishes. Only about $260 actually chips away at that massive $200,000 debt. So you can see why month after month that huge number barely moves.
All right, so let's wrap this up. What's the final verdict here? What's the big takeaway for anyone even thinking about one of these loans? Let's boil it all down. Look, the bottom line is you're signing up for a huge lump sum payment down the road. Those monthly payments, they're barely touching the principal. This whole thing can be, and I quote, too much to handle if you don't have a bulletproof plan. Everything, and I mean everything, hinges on you having a massive pile of cash ready when that balloon payment is due.
Now, does this mean they're always a terrible idea? Not necessarily. For some people, it might make sense. If you have a rock-solid, guaranteed plan, like you're a real estate developer who's going to flip the property in 2 years, or you know for a fact a massive bonus is coming on a specific date, then maybe. But for the average person whose financial future isn't a sure thing, wow, it is one heck of a risky gamble.
So there you have it. The secret's out. Now you know the trick behind the low payments. You've seen the math, you get the risks. So the big question, the one you have to ask yourself is this: is the short-term comfort of a low payment worth that enormous risk waiting for you at the finish line?